3 independent systems crossed historic thresholds in the same week, not sequentially, simultaneously. COMEX registered silver fell below 80 million ounces for the first time in this entire bull market. The LBMA published vault data showing its silver to gold ratio dropping below 3 to 1 for the first time in modern market history. And the private credit market in the United States entered a synchronized gating event across 3 of the largest alternative asset managers on the planet with $585 billion of banking exposure sitting underneath. 3 fractures, 1 week. Nobody in mainstream financial coverage is reading them alongside each other. That is what we are here to do. Every number sourced, every line of math explained, no opinions disguised as data. Today is Tuesday. Silver is at $88.43 on the bid. Let us start with the math. Friday, March 6th. 5 COMEX vaults moved in the same direction in a single session. Here is the custodian level breakdown. Asahi, 1,269,300 ounces physically withdrawn from COMEX. Not reclassified, withdrawn. The metal left the exchange entirely. Brinks, 150 ounces reclassified from registered into eligible. Registered means deliverable against a futures contract. Eligible means the metal remains in the Brinks vault physically, but the owner has pulled it from the deliverable pool. The silver did not leave the building, it left the game. CNT, 146 ounces physically withdrawn, gone from the system. MTB, 2 movements on the same day. 1,242 ounces physically withdrawn plus 644 ounces reclassified out of registered. MTB alone removed 186 ounces from the deliverable pool in one session. StoneX, 531,345 ounces adjusted out of registered. Add the registered category changes across all 5 vaults. 1,145,139 ounces of deliverable silver removed from the COMEX pool in one Friday afternoon. New registered total, 79,988,594 ounces, below 80 million for the first time in this cycle. Context: COMEX registered peaked at approximately 240 million ounces in 2020. 2/3 of the deliverable silver that existed in this system 5 years ago has either been physically removed or reclassified out of deliverable status. The combined COMEX vault, registered and eligible together, now stands at 346 million ounces. In October 2025, that number was approximately 532 million, a 35% total inventory decline in a commodity that takes 7 to 15 years to bring from discovery to production. Now attach the May contract to that number. This is where arithmetic replaces opinion. March 2026 contracts still show 1,281 open at Friday's close. At 5,000 ounces per contract, that is 5,000 ounces still potentially standing for March delivery. When those remaining March obligations complete, registered falls from 79.9 million to approximately 73.6 million ounces. May open interest at Friday's close, 76,948 contracts. 384.7 million ounces of paper obligations sitting against a registered vault projected at 73.6 million ounces post-March. Paper to registered ratio, 5.2 to 1. Now we're on the delivery scenarios, not predictions. Arithmetic. 10% of May contracts stand for delivery, approximately 7,695 contracts. 38.5 million ounces demanded. Registered pool falls to approximately 35 million ounces before June begins. 20% stand for delivery, approximately 15,390 contracts. 76.9 million ounces demanded. That exceeds the entire post-March registered vault. Every deliverable ounce consumed and the obligation is still not fully met. 25% stand. The shortfall is approximately 22.6 million ounces that the exchange must source from outside the registered pool entirely. These are not extreme assumptions. These are straightforward percentages applied to published open interest against published registered inventory. There is no modeling required here. There is only subtraction, and the subtraction does not work. While COMEX vaults are draining, London crossed its own threshold. The LBMA published end of February vault data this week. Silver to gold ratio, 294 to 1. Below 3 to 1 for the first time in modern market history. Here is why that specific number matters. Global silver mines produce approximately 820 million ounces per year. The geological extraction ratio is approximately 7.88 to 1. For every ounce of gold pulled from the earth, nearly 8 ounces of silver come with it. The LBMA vault is holding silver at 62% below what the natural production relationship between the two metals would proportionally suggest. The monthly drain rate confirms the trajectory. February silver stocks fell approximately 664 tons below January. At that pace without acceleration, London vaults reach approximately 19,000 tons by end of 2026. The gold to silver price ratio today sits at 59 to 1. The vault says fewer than 3 ounces of silver exist in institutional clearing storage for every ounce of gold. One of those ratios is anchored in physical reality. The other is anchored in paper. Shanghai physical silver is trading between $95 and $100. COMEX sits at 88. A 13 premium between two connected exchanges should theoretically close within days through arbitrage. Buy in New York, ship to Shanghai, collect the spread. It has not closed. Here's why. China implemented a silver export licensing regime effective January 1st, 2026, requiring all exporters to hold at least 80 tons of annual production capacity. That requirement immediately excluded the majority of smaller producers and traders from exporting silver out of China. Metal now flows in one direction, west to east. The reverse route is structurally blocked. The landed cost of Western silver entering China, accounting for the 13% value-added tax, shipping, insurance, and logistics, runs approximately $80 to $82 per ounce. No rational holder sells below the price at which an economically motivated buyer on the other side of the world will pay to receive it. The Shanghai Premium is not a glitch. It is the physical market broadcasting a structural floor price for Western silver continuously and persistently through a premium that arbitrage cannot collapse because the deliverable metal to execute that arbitrage does not exist in sufficient quantity. Let us put the complete picture on one table for this single moment in time. COMEX registered silver 79,988,594 ounces as of Friday. Projected post-March, 73.6 million. May open interest, 76,948 contracts, 384.7 million ounces of paper obligation, paper to registered ratio, 5.2 to 1, LBMA silver to gold vault ratio, 2.94 to 1, below 3 to 1 for the first time, monthly LBMA drain rate, 664 tons, Shanghai Premium over COMEX, $13, no functional arbitrage pathway available to close it, 4 data streams, 4 independent sources, 1 directional signal. May 1st notice day is April 30th, 2026, 51 days from today. Between now and that date, every holder of a May contract makes one of 3 decisions. Roll to July, close the position, or stand and demand physical delivery. If delivery demand exceeds registered supply, COMEX has 3 resolution paths. First, eligible to registered conversion. Eligible holders have every structural reason to wait. The only mechanism that changes their decision is a cash incentive large enough to overcome that preference. That implies a significant premium over current spot before the first eligible ounce moves. Second, emergency inbound sourcing from foreign vaults. The LBMA is losing 664 tons per month. Any meaningful shipment from London to New York to address a May delivery gap further accelerates the drain on a vault system that just broke a historic ratio this week. Third, cash settlement. The administrative conversion of physical delivery obligations into cash payouts at an exchange-determined price. That is the public acknowledgement that a physically settled futures contract can no longer be honored as designed. In every historical commodity case where cash settlement was imposed against a physically settled contract, the price response was immediate and severe. None of this means silver travels in a straight line between now and April 30th. Markets never move in straight lines, and this one will not be the exception. What the math establishes is the structural framework. The subtraction does not resolve on its own. The vaults do not rebuild organically. The LBMA ratio does not self-correct. And the Shanghai Premium is not closing because the physical infrastructure to close it has been legislated out of existence. The question has never been whether the paper price accurately reflects the physical market on any given day. It clearly has not for months. The question is, what forces the reconnection? The answer sits on a calendar. April 30th, 384.7 million ounces of paper against 73.6 million ounces of metal. The arithmetic is public. The data is verifiable. What happens when subtraction meets a delivery window that cannot be deferred is not a matter of opinion. Verify every number we presented today. Pull the COMEX Vault report. Read the LBMA publication. Check the Shanghai spot price yourself. That is the standard. That should always be the standard. 51 days. The math does not negotiate. This is Shadow Finance. We will see you tomorrow.